Hi everyone, hope you all are safe and doing well. In this session, I'm going to cover Market Risk 101 and I plan to create a series to cover different types of market risk, ways to measure it, and mitigation approaches. But for now, let's try to understand what is market risk. Let's say you have $100,000 as part of your either investment portfolio or trading portfolio, and your investment portfolio might include let's say some of the long-term corporate bonds, mutual funds, certificate of deposits, etc., while the trading portfolio may have stocks, commodities, and stuffs like that, right? Now, whenever there is any movement in either the stock market or commodities market, or if the interest rate or forex rate changes, and together all of these things are called market risk factors, right? You will definitely see some sort of swing uh, in your portfolio. It may go up or it may go down, but you will definitely see some sort of changes in the portfolio. Now, if the value of your portfolio increases due to market movement, that is obviously a celebration time, isn't it? But what if the market movement leads your portfolio to kind of lose its value? And that may actually happen, right? I mean, you can't expect to always have a red letter day. So there will always be a risk that the value of your portfolio will decrease due to the changes in the market, or securities market or commodities market, or as I said, any of the market risk factors, and that risk is called market risk. Now, at a very high level, there are four different types of market risks. The first one is the interest rate risk, which means the risk arising due to the movement in the absolute value of the interest rate. Okay, let me put it in the middle. Okay. Now, to put it in simpler terms, let's say you have corporate bonds in your portfolio. Okay, and if you do not know the price of the bond, demonstrates an inverse relationship with the interest rate, which means as the interest rate increases, right, as the interest rate goes up, the bond price will go down, and vice versa. Now, if the value of the bond decreases, obviously your investment portfolio will start losing its value. Now, how does the correlation between the interest rate change and movement in bond price play out in conjunction with increase in maturity is something that will be discussing in some other session. But the bottom line for now is due to the movements in interest rate, there is a huge amount of risk that you are required to manage, right? That you are required to ensure the sensitivity of your bonds portfolio can be restricted, right? So that is a brief about the interest rate risk, and with that, we will move on to the second type of market rate risk, which is called, you know, FX risk or forex risk or currency risk or exchange rate risk as well. So FX risk refers to the risk arising from changes in the exchange rates between the currencies. FX rate can further be classified into transaction risk, and then I think economic risk and translation risk as well. Again, the details of these I'll probably take up in a separate session when I'll be talking about the foreign exchange rate risk. Uh, uh, but for now, if I have to explain you what FX risk is, right, in simple terms, basically this is considered as a major risk for exporters, importers, or the businesses that trade in international markets. Let's say, to understand with a simple example, let's say uh, uh, you struck a deal with someone in the UK to purchase 100,000 liters of beverages every month for the next 2 years. That's a fixed price, right? Your payments will also go on a monthly basis as you receive your consignment. Now, if the value of GBP keeps getting stronger against your home currency, in essence, you will basically end up paying more money than the agreed upon price, right? and you may come to a point that you don't find the deal to be profitable anymore, right? So there is always a forex rate uh, risk involved when you are dealing in foreign currencies, and there is, and I mean, basically this is an extremely basic example of how FX risk would come into play when trading internationally. All right. So with this, we will move on to the third category of market risk, which is uh, commodities risk. Let me just pull this up. Okay. So this is the risk that arises due to the adverse movements in commodities price in the market. Again, in simple terms, if I have to explain you, let's say you produce and sell crude oil, right? Now your production cost is, let's say, X dollar per barrel, and your selling cost is, let's say, X plus $1 per barrel. Now, due to some unforeseen events, the demand of crude oil goes down significantly as opposed to supply. Okay, and this leads to a major downfall in crude oil prices, and subsequently you are forced to sell your crude oil inventory for suppose X minus $1 per barrel, meaning you start selling your production in losses, right? So as a commodity trader, the commodity risk is one important factor that you need to manage to sustain your business, right? So hope I was clear in terms of explaining you what is the commodity risk. Now moving on to the uh, last category of market risk, and this is called equity risk. Pretty much self-explanatory here, right? And if you are uh, any sort of trader, big time or small time, you would have definitely experienced this at some point in time during your trading experience. So this is the risk, basically that arises from the changes or volatility in equities market. Uh, 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 let's take an example from 2018, right? uh, if you had a portfolio that constituted majorly the tech stocks, let's say Facebook, Apple, Microsoft, etc., then during the famous 2018 uh, tech crash, a major chunk of your portfolio might have been wiped out, right? And that was only because of the equity risk involved in sale and purchase of the securities. Now, we just talked about what is market risk, what are the different types of market risk, but then uh, the discussion will remain incomplete if we do not talk about what are the different ways how the individuals or banks or financial institutions measure these, measure market risk, and what are the different ways that they adopt to mitigate uh, the different types of market risk, right? So I will make videos on each of the different components of market risk, because it would be difficult for me to cover everything in one session, and then obviously it would get boring as well. So with this, I will take a pause here, and as usual, if you have any